Investment products. In the dynamic world of investments, mutual funds, index funds, and exchange-traded funds are fundamental instruments to building a portfolio. Each offers distinct features catering to diverse investor preferences, risk appetites, and financial goals. Understanding their similarities, differences, and key features can help you determine where they fit best in your portfolio. At their core, all three investments pool investor money together to invest in a portfolio of different securities, offering a convenient way to access a broad spectrum of assets with relatively small amount of capital. Additionally, they provide professional management by experienced fund managers. Since these all pool investments together, they also carry internal costs known as operating expense ratios. Consider these investment vehicles as slices of a pie. Rather than investing the time and effort into sourcing the ingredients and baking an entire pie yourself, these investments offer you the advantages of enjoying a full pie without the need to undertake all the preparation work yourself. Furthermore, mutual funds, index funds, and ETFs offer investors the advantage of liquidity, allowing them to buy and sell shares in the open market. This liquidity enhances flexibility, enables investors to react to market changes, and capitalize on opportunities, or adjust their portfolios as needed. Now let's talk about the differences, such as the management style. Mutual funds are actively managed by professional portfolio managers who aim to outperform the market, a benchmark, or employ a unique strategy. These managers regularly buy and sell investments within the fund to achieve their objectives. Index funds, on the other hand, are structured like mutual funds, but instead are passively managed to replicate the performance of a specific market index, such as the S&P. They aim to match the returns of the index by holding the same securities in the same proportions. ETFs, however, can be either actively or passively managed, but most commonly, they follow an index. They trade on exchange like stocks, with prices fluctuating throughout the day based on supply and demand. Now let's talk about trading. Mutual funds and index funds only trade once during the day, since buys and sales are regulated by the fund. They trade at net asset value, which is calculated at the end of each trading day. ETFs, on the other hand, trade on exchanges throughout the day at market prices just like stocks. Their prices are controlled by supply and demand. Now there's cost structure. Mutual funds typically have higher operating expense ratios due to their active management. They also potentially come with sales charges that investors have to pay upfront or when they sell their shares. Index funds, however, tend to have lower operating expense ratios than actively managed mutual funds since they're passively managed. ETFs have lower expense ratios compared to traditional mutual funds, but can carry trading costs or commissions since they trade through exchanges. Now let's not forget about taxes. Now this applies to any type of investments held outside of a retirement account. With mutual funds, due to their active management, they tend to be less tax efficient. The transactions that occur throughout the course of the year can result in capital gains distributions to the investor that becomes taxable in that year. This is despite not even selling the funds that they own. With index funds, due to their passive management style, they tend to have lower portfolio changes, resulting in fewer taxable events. This can lead to reduced capital gains distributions, potentially lowering investors' tax liabilities. And then with ETFs, similar to index funds, since they have lower portfolio changes, there's fewer capital gains distributions compared to actively managed mutual funds. Additionally, ETF investors have the flexibility to control when they realize capital gains by choosing when to buy or sell their shares. And since they are traded throughout the day, that allows investors to take advantage of using them to do things such as tax loss harvesting. While mutual funds, index funds, and ETFs share common objectives of providing diversified investment opportunities and professional management, they differ in their management style, how they're traded, and cost and tax implications. Understanding these distinctions empowers investors to make informed decisions aligned with their financial objectives, risk tolerance, and tax considerations. By leveraging the unique features and advantages of each vehicle, investors can build portfolios tailored to their needs while controlling costs and taxes. Take advantage of our free financial assessment to review your portfolio to see what you own, why you own it, and if it makes sense to adjust your portfolio so it's better aligned with your objectives.